Alright, guys, I hope this work. We will see. We will see. Let me double check real quick. What's going on here? Okay, I got that sorted out. Also too, let me see my channel right here. One second. Yes, so I'm on. Probably no viewer yet. I'm just testing this out. And let's go. Okay, so I won't be able to see any chat, which I don't expect anybody to know that I'm live right now. I'm just testing this out. So today we're going to be talking about GameStop. And I was looking at the price today. Of course, it's stuck at this price point. Now I have a couple hours to kill today because I don't have to go to work. I have something coming up at 1 o'clock. So, hey, I might stay until then. But excuse me 1 second. I'm here with my coffee and whatnot. But anyway, so let's get the show started. And just so you know too, I'm getting a new microphone, so if I sound terrible, I'm sorry about that. I've been trying to get new microphone for a long time, but today is the day. But I just ordered last night actually, so hopefully it comes around, I don't know when. I'll let you know and you'll find out. Alright, so what am I going to show you today? Now, of course, GameStop has been decimated, right? And even lower than the low that you see right here. I'll go back to what I was going to show you later on. But if you look at the right here, oh man, here, the brush. Right here versus right here, it's broken that support line, so that's fine. You know, hey, if they want to bring it down lower, which I kind of expected that. Now right now we're trading at this green light right here, green line right here. Again, I'm not a technical analysis person, so please don't make any trade based on what I said here. What I've noticed here is that we are going back very far to the highest GameStop ever been traded in the market. Now, historically, if you see stuff like that, you know, well, actually, this was the highest. Now we're trading at the second highest before the run, right? We know where the run is. Right here, so keep an eye on that. I'm expecting it to go down to even $12. That's fine too, because these levels I have been kind of watched these levels a long time. If you look at my past video, these are the levels that I'm looking at. But again, I'm not a trader, short-term trader for this particular stock anyway, because I'm here for the long haul. I'm here for the run. I'm here for the historical historical run, right? Hey, I'm just dreaming here, okay? I'm just dreaming here at this point. But hey, anything could be going on right here. Of course, if you look at the market right now as a whole, this is the S&P 500 index, and we are trading kind of, I'm terrible at this, huh? But anyway, so if you look at this right here, we are kind of trying to hold on for dear life right here. So it's remained to be seen. Obviously, the economy is not doing well, and I wouldn't say that it's a expansion here. The rates goes up. I guess the bond market went down. If you look at TLT, and we're gonna talk about that too, because I as GameStop shareholder, we know that we have marketable security, and based on what we read in the balance sheet, it is a treasury bond, right? U.S. treasury bond. So if you look at the value of treasury bond lately, it's been dumping like crazy, right? Now I'm gonna try to find a better one because this one doesn't have a long. Let me try this one. Yeah, I think this one is a better one because it gives you a better look at that. Now, I did this years ago, months ago, I should say, just to play around with it. Like, okay, where is the level I should be looking at? I was trying to trade the treasury bond at the time, and just to dabble. I'm not an expert by any mean, but if you look at the level that I have been watching is the level that was kind of previous historical price action right here, right here, right here. Never been this low. I thought this would bounce and it's gonna take us to a higher high right here, right? But it's kind of play with this level right here, and kind of didn't even touch that level actually, but if you kind of watch this particular one too, but if you look at that and kind of act as a support, right, and boom, done, right? So is it going to turn out to be lower than this low? Ever since back in 2005 right here, 2007 right here, and then when not 2007 or 2008, we know what happened, right? The bond yield went up like crazy. Now, this is a 20-year treasury bond, okay? I'm not saying that GameStop leadership put it in this particular treasury, okay? But historically, if you look at, what happened in 2008, 2007, that's when, I think like Michael Burry, the guy who short the housing subprime mortgage loan, kind of make his prediction around this time, right? 2005, he's starting to, sounds the alarm bell, and nobody listened to him until 2009. That's when he, kind of his fruit of his labor in terms of shorting the market, kind of give him that, billionaire status because everything was just crumbling down. Okay, 1 second. But anyway, so, all right. So, alright, what am I saying? So, what I'm trying to say is that, we don't know when the treasury bond is going to consolidate. At this moment in time, it seems like everybody is dumping the treasury bond in order to, I don't know, I guess China does it, Saudi Arabia does it, even our own Fed is trying to dump treasury bond because they've been buying it like crazy. When you have this type of run on a 20-year treasury bond, this stuff doesn't run. And keep in mind, this is a monthly, okay? It is a monthly thing. Okay, hold on, sorry, I might not show you. Okay, I see. Sorry, let me shrink this down a little bit. And again, hey, I have hours to kill here, so let's okay, there you go. That's what I'm trying to show you. I want you to see the price right here. Now, what I was saying is that the movement of this type of run right here is unnatural, right, for this type of long-term treasury bond because they don't run that much day to day, right? Even month to month too. If you look at this is the daily chart, and then you have weekly chart right here. You could see that it's a very slow moving asset, right? So back to Jimmy though. Is it going to be lower than the historical right here, right? That's when we see the sign of trouble right here, 2007. Everybody was chatting about how, oh my God, the housing market is so robust and da 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 and da da da, right? And then we all know what's happening in 2008 and 2009. Now, my point is that 2009, it wasn't until a year later when the treasury started to go up again. Now, there's an inverse relationship between the yield and the value of treasury. Okay? So, when the treasury goes up, when the treasury yield goes up, I'm sorry. There we go. Yields goes up, the value of the bond went down. Okay? So keep that in mind. Value went down. Okay? This is where it is right here in the red. Okay? So at the time, the yield was high, very high, just like how it is right now. 20 years, I don't know what it is right now. It's probably close to 5%, 5.5. But the shorter term is actually higher than the 20 years yield. 20-year treasury bond. Jeez, I can't even talk. And then if you look at this high right here, this is when the crash happens. So what I'm trying to say to you is that you might not see the market crash happen until the yield starting to spike up right here. The minute that the value of this bond goes up, remember, value goes up, yield went down. That is when you started to see a problem in the stock market, because again, the damage has already been done to the market because of this high yield interest for the economy. Okay, so right now we're still waiting on the consolidation. Now when it ping pong around here, not quite sure, it could go down to 6. Who knows, right? Now at this point, of course, the yield is going to be a lot higher than what it was in 2000 or in mid 2007, right? 2008, it went up a little bit up here, right? And so my prediction, I said, hey, if a selling pressure is down to this, GME treasury bond might go down a little bit more. Now, again, I don't know which one GME has in the moment, but 20 years, 10 years even is a good buy when you're trying to time the rise of treasury bond. Okay, so again, like if you measure this from here, from the low to this high right here, that's a 50% rise in 2 years. Okay, and on top of that, you still have the monthly or the APY, like whatever it pays at the time. So you double your kind of increase in value in terms of dollar amount when the yield went down either to 0 again or to 1%, a very low percentage. What I'm trying to say, it's lower than it is today. Okay, we don't know when. Again, the Fed has already been spoken to the market, and they always signal the market to be cautious, and we are higher for longer. They're not going to cut rates, they're gonna keep it high for a long time. Now, long for them, we don't know how long. Could be years, could be a couple months. All I know is that we just have to wait for the Fed to keep their act together. Okay. I hope I make sense. Sorry, this is my first live. I bet nobody even watch this live. So I'm banging on it. Oh shoot, there's a couple of viewers. Hello everybody. Sorry, again this is my first one, so please don't kill me because I'm terrible. All right. So let's see. Oh, now I'm very nervous because people are watching. So let's go with what I'm trying to say. So what I'm trying to say is that we have a treasury bond of $300 million of this, right? And it could be the 10-year, could be the 20 years. So I don't know. But if it is the 10-year, it kind of have the same effects, right? What my prediction, right, based on what this chart is telling me is that when the Fed start to cut rates, we are going to see that $300 million. Oh, sorry, that $300 million turn into more than that. Okay, now at this current price range, though, let's say the Fed start to hike the rate even more, this 300 million will go down in value. But it's still accrued interest from that, right? So I'm not saying it's going to come down to here. I'm just saying if it does, then that $300 million is going to be, down to 200, whatever, 95, right? I don't know. Again, I'm just making things up here. Please don't kill me. But my point is that it's going to come down in value, right? But the interest, again, it will still keep accruing until the Fed starting to raise. Until the Fed, oh my God, getting nervous over here. Until the Fed starting to cut rate, just like here in 2009, right? This is when they started to cut rate. So until then, I'm sure, if Jimmy, I feel like Ryan Cohen will know when to add more. He could add more over here. You see what I mean? So instead of 250 or 280 million, he's going to increase it by, a couple millions more, or maybe 50 million more. Who knows, right? If they have more money to put aside, so that they could capture that growth, that massive rally for bondholder. This is a very long-term prospect here I'm talking about. So maybe 5 years from now, this 300 million or whatever, how much he added more to the bond is going to be 500 million, Again, I'm making things up here because it's just a correlation of the nature of yield versus value for the Federal Reserve. Now, I should do more research on this one. How much was the rate then? Was this at 0? Or was it at 3? I don't know. See what I mean? So, again, the Fed will cut rate at some point. And when they do, this bond value is going to go up for Jimmy. So that's what I'm waiting for. Again, it could be a year from now, 2 years from now, 3 years from now. But we need to see this Hold on. We need to see this consolidation first, you know, or whether it's going to dump here. We don't know. Again, you know, anything could go wrong at this point in time, right? All right. So let's go back here. Okay, the market is recovering right now. That's good. That's good. Let's look at Gamestop. Ooh, ooh. There we go. Our favorite stock. Ah, why am I doing that? Alright guys, I know if you comment on the chat box, I appreciate that, but I don't have any ways to look at it right now. Again, this is my first live. Forgive me, I don't know who is watching. Prefer nobody to watch me tumbling down over here. Alright, so it went down right here. Oh my goodness. Oh my god, you better sell, you guys. Come on. It's gonna go down to 9? Oh my god, I'm so scared. I'm so scared. Alright, sorry, I'm just playing around. Alright, so how far can it go? Well, I mean, again, I was watching this level right here, and it's not out of the question. But if you look at these levels that I was pointed out earlier, you know, $12, sure. How about $9, right? How about $9? Okay, sure. But keep in mind though, you guys, keep in mind, this is when Ryan Cohen bought in, okay? Our CEO right now. So Ryan Cohen bought in at this price right here. You could see it in filing because November 2020, that's when he wrote the letter to the board of director, and then this is when he did a SEC filing of adding more. So he bought it around this price range right here, around, let's say, on average $4 a share. Okay, right here, $4 a share, and then he's been in it ever since. Now he also did a filing at around $22, right? I don't remember at what point did he buy into it. I just remember seeing, well, let's go and look at it, huh? Shall we? So this is the SEC website. Anything to do with any company at all, it will be right here. So, oops, actually, I need to move it down here. Don't know why I did that. Search. Okay. Hope you guys could see this. Okay, so this is Larry Chain, obviously. They bought into it just recently in September 8th after the earning. Very encouraging, we know that, but I want to look at when Ryan Cohen bought $10 million of our stock. Okay, bear with me. June 30th, 13. Okay, let me blow it up real quick here. June 9th. Okay, I'll mark that up. 22. Look, close to $23 even. So June 9th. Okay, June 9th. Let's mark that. Mementos. June 9th. Right here. June 9th. So Thursday. Let's mark that. September. Oh, wait. What year? 23. Goodness. June 9th of 23. Right here on Friday. So naturally, you could see right here, that is why the stock just went berserk, right? And then pff, they smack it down again. And so what am I trying to tell you? Okay, so let's, I think around here, this level and this level, around 22 something, 22, 24, $22.24. Okay, let me change this to what color should I put? Let's do blue, dark blue for Ryan Cohen. Right here. Boom. Even higher. Bear with me, you guys. Bear with me. All right. So my point of trying to tell you here is that you have a CEO right now who bought $10 million at a higher level than the price that it is today. It's insanity. To me, if you could get in earlier than the insider out there, there's no company in the whole world right now that you could buy at a lower price than the actual CEO and the executive itself. No one. But anyway, they want to bring it down even lower. Okay, let's do it. It's commendable. It's commendable. Now, I don't know why I marked this one, so let's delete that one. And so, and then also too, you never see the inside selling. In fact, they even add more as we speak, right? Now, Larry Chain and Alan Adel, I might butcher his name, but sorry, bought at around $17. So even lower now in the price range than the other executive that just added around this time. Remember September 8th, right? We saw that one. And so, man, so it's cheap. It's cheap, to say the least. But anyway, so I want to address this comment right here. Bear with me 1 second. I actually wanted to make that video last night, but I forgot to record, so I waste a whole bunch of minutes doing that. I'm gonna hold on 1 second, you guys. I feel so unprepared right now. Hey, I'm just chilling. 5 watching. Thank you for watching. Thank you. Alright, so, and for those of you who are watching, I appreciate you being here. So I wanted to do this comment right here, right? And I appreciate the comment coming in. One of the things I appreciate about this one, let me build this up so we could see together. I'm not a good reader. I'm very slow at reading, but so please forgive me. Alright. And so I wanted to do this video last night, and I was wasting a whole bunch of time, did not press record, so since I have some time to kill today, let's do it here. And so again, I was gonna say that I respect this comment because number one, it's very respectable, meaning that it gives me facts and figures and actually a good argument, to say the least, because it lays with number, facts, and figures right here. Obviously, I'm disagreeing with all of the all of this. No, of course, it has good points, to say the least. So I appreciate those comments, and also comments that echo the GME echo chamber. Those comments also appreciated. All right, so let's read through this together. So the enterprise value ratio, enterprise value versus revenue or sale, ratio for GameStop is higher than any other retail, such as Target, and we'll go through all these companies together today. Target, Best Buy, Macy's, Kohl's, and Nordstrom. All of these companies have long-term debt increasing their enterprise value, unlike GME. So in this valuation metric is somewhat biased against them, and they are still cheaper according to it. Respectable. If you look at the more commonly used price to sell instead of enterprise value versus sale, it makes GME look even more overvalued in comparison. The company I mentioned earlier traded at 0.1 to 0.4 price to sell compared to 0.8 for GME. So I would say that the current valuation for GME is optimistic. Also, it's not logical to compare valuation multiples of GameStop to a pharmaceutical company. Even the most beaten down value stock in J&J, that's Johnson & Johnson, sector traded at over 2 to 3 enterprise value versus revenue because it has inherently higher margins than retailers do. Okay, I understand that. Thank you again. But my point is that no one metric, one should use to evaluate a company. I understand that. But my point in pointing out that particular metric is that if you look at the Google, if you Google it, which is where I get my education, right? I'm trying to understand why all of these analysts do not give GME a fair shake in at least evaluating it correctly, right? In my opinion, only one analyst? Are you kidding me? That is willing to give this company some, like, it's laughable, Is it untouchable in that sense that, and so that is why I went through it myself and try to understand it from my own point of view, right? Now, as far as all of these companies, so let's look through it together. I agree with you that all of these price points for all of these retailers are cheap compared to GameStop, even though with their debt loading onto it. But here's what I want to show my audience here. Okay, so if you look at Target, right? If you look at Target, of course, they have a whole bunch of revenue, a whole bunch of income, right? A whole bunch of enterprise value. Sure. Dividend, look, they are paying out dividend. Dividend payout ratio, 60% of the time. And here's what Moran's Rants was telling, and it's kind of like true too. In all of this company, I bet you anything, they're trying to depleting the resources from day to day. I'll show you what I mean by that. It's like by paying out dividend, just like how they did it in GameStop, right? Even though they have no money to service the debt. So let me blow it up a little bit bigger here. Oh, actually, I forgot. Boom. There you go. Have to remember to do that all the time. But hold on, maybe 2. There we go. I hope everybody could see that. So yeah, we talked about the dividend thing. Share outstanding, not too bad for a company the size of Target, right? But look at the PE ratio real quick right here. Let me blow up here. Right here. So the PE ratio is 14 times its earning. Is that a high valuation? I think so. If you look at Google, again, my education is from Google. What is good for the PE ratio? So a quick way to gauge whether it's undervalue or overvalue. What is the number right here? Below 10, right? Below 10 is a good buy, right? Or at least, hey, it's getting to be cheaper. So if you look at Target, it's 14, so it's still high. Now for GME though, we know that because it's in the negative, the income statement, which they're gonna fix. I realize that, so I can't compare that right now. We have to wait until they're profitable, right? Which I think they will. And just like any company, they're struggling to make ends meet here. So, hey, price to sell very cheap, very cheap. Forward price to sell cheaper than GME. I agree with you. Price to book, GME wins. So GME right now is 3.58. I can't read. So if you look at the market capitalization divided by shareholder equity, so the lower the better for shareholder. It means that the number up top is smaller than the number down below when you do the division, right? So when the number up top is lower, which is the capitalization, the lower the capitalization, meaning the share per the dollar amount per share stay lower, what do you get? You get more of your shareholder equity in the company, get more stake in the company, okay? PEG ratio, anything below 1, as I had done my video before, is good, right? Now, we want to fix this. Obviously, the free cash flow, we want it to be higher than the capitalization. That would be amazing. But if you compare this number to any other retail out there, Target, for example, Target is higher. So we want lower than right here. So let's look at Google real quick. So what is the good price to cash flow ratio out there? Ooh. For the stock, below 10. So yes, we want it to be below 10. But if you compare it to Target, there you go. Let's compare it to Best Buy. Now this is a closer comparison, I would say, to GameStop. But I'll show you another metric that I use that I think it's more important than any of this, right? I'll show you later on. Now, Best Buy has a good, like, that's good. I love that, to see this type of thing, you see? Cheaper. But then I'll show you what I don't like about it later on too. But as far as price to cash flow, that's good. But look at the PEG ratio, right? So what is a PEG ratio? It is a price to earning to growth ratio. It's calculated by dividing company's price to earnings ratio by its expected earnings growth. Okay, so the lower it is, the better expected growth, earning growth it is. Let me say that again. The lower this number is, the better expected earning growth it is. So, who have the earning growth of lower than 1? GameStop. Okay, so this is GameStop. So let's look at Target. Target is 3. So expected earning growth is low when this number is high. 2, that's not too bad, right? It's better than 3. So let's look at Macy. since the enterprise is price to sell amazingly low, that's good. Price to earning amazingly low, that's good, right? We want it to be less than 10. That's good. Look at this. Price to free cash flow, low, that's good. PEG ratio for Macy, that's good. Good. So evaluation ratio, that's pretty good, meaning that it's undervalued. Correct. You are correct in saying that. Excuse me, 1 second. All right. Sorry. I had to take a sip of coffee right here. Okay. So that was Macy, but look at Cole real quick. Let's go to the stats. As you could see right here, of course, yes, very low. That's good. Price to cash flow, very low. PEG ratio, very low. So valuation of these company, you are correct in saying that. Perfect. Now prices. Look, this is the one that we disputed on. That's good. Or I should say just discussion in general, not disputing anybody. Okay, and then Nordstrom. Okay, let's look at that real quick. Oh, wow. This is actually good. Okay, so Nordstrom is price to sell. That's good. Under 1. Let's see. PEG ratio. That's good too. That's good. Okay. But look at the price to earnings though. Why is it so high? 80? What's going on there? I don't know. Yes, price to sell, enterprise value versus sell is lower than GameStop. Okay, so this is the point that I kind of get very concerning about all of these retailer store that was pointed out to me. So I'm gonna go through them right here. Wait a minute. Right here. So financial position. Is it more important than all of those ratio combined? Well, to me, all of those ratio are retroactive, like it's in the past. So to me, the financial position is more to do with the future of the company, right? So in my opinion, I think this is more, I think it holds more water, more weight to evaluating the company, because it doesn't matter what the company did before. It's what they're doing in the future or going to do in the future. And to me, the financial position is going to tell us that, right? Okay, so let's go to GameStop. Okay, ready. Boom. And I pointed out this particular, metric before because, again, to me, hey, this is going to be the future of the company. Now, I would argue that in this high interest rate environment, having debt is not going to serve anyone. It used to be, a lower interest rate. You could refinance it. You could, beat the inflation in that terms if you could earn more than 2%, of whatever you're borrowing. And then, kind of push out a 30 years mortgage loan. And 2 or 3%, very low rate, you're going to be able to do fine in this environment, right? But for corporate bonds or debt or all that stuff, they have, higher tax rate, right? From what I'm understanding. But, if you look at like Amazon, for example, they have a very low lower rate of effective tax being paid to the government. I'll show you that later on too if you have time. But anyways, I'm going off the tangent here. So let's go through the ratio right here. Look, boom. So GameStop has more asset than its liability, close to 2 to 1. So for every asset that they have For every two assets they have one liability close to it, right? So this is what it means. So typically we want it above 1. That's good. Quick ratio, the same thing. It's above 1. So if you look at the definition right here, it's just cash, short investment, account receivable. All of that, they are higher than the current liability. That's why you see 1 there. With debt to equity ratio, though, you want your equity to be higher than the debt. So currently, the ratio is 2 to 1. So shareholder equity is twice as much as its debt. So that's good. Anything below 1 is a good standing, right? Now, debt to cash flow, though, we want it to be below 1. 2 is not the end of the world, but I want it to improve. But so let's see what Google says. What is good for? Free cash flow to debt is calculated by free cash flow divided by total debt. So this one, they do the opposite. So this ratio gives us an idea of how fast the company cash flow is compared to its debt. The high value means debt is low. Now, sorry, hold on 1 second. What did it say? High value meaning the debt is low. So it's the opposite because cash flow is on top, the way that this is written. So if you have debt on top of cash flow, then it means lower value means the debt is low. Does that make sense? Because in our metric right here, they put the debt up first. Okay, so we want this to be below 1, essentially. Okay. Interest coverage for GameStop, it's close to 6, 5.91 right there. So let's go to Target. Look at Target. Current ratio is below 1. Terrible. No, not the end of the world, but you want it to be below 1. 80%, that's not too bad. Quick ratio, it's not available. Debt to equity ratio, they have more debt than shareholder equity. That's what it means. They have more debt than earnings before, I think they wrote an interest and tax. I forgot what D was, and then a amortization or something like that. But again, we want this to be below 1, and it's 2.5 for Target right now. For this one, debt to cash flow, we already, so low is better because again, this is inverse relationship. So we want it to be below 1. Oh, this is GameStop. This is Target. We want it to be below 1, but GameStop beats Target in this particular metric. So GameStop beats this one metric. GameStop beats this one. GameStop beats this one. GameStop beats this one. However, interest coverage, because Target has, I guess lower than the actual earnings. Hold on, let me see how this was yeah. So their earnings is a lot higher than its interest expense. Sorry, I'm stretching right now. Interest expense, that's why it's higher than GameStop. But GameStop, again, this is the rule of thumbs, right? Anything above 3 is good, and it's good for financial standing. So Target is better in that sense. Alright, so this is Best Buy. I think Best Buy is the best, closest, comparison to any other retailer because they sell kind of the same thing as GameStop, so electronics and all that stuff. Now the other company like Target, Macy's, Kohl's, and all of those, they are other retailers, so they sell out different things. So again, it's like it's not fair to compare those, sector again because they have more things to sell. So with this one, Best Buy, pretty good. I mean, 99 is pretty good, meaning close to 1-to-1 ratio. Current asset versus liability, quick ratio, below 1, a lot more liability than cash and, available cash in the coffer, so to speak. More debt than shareholder equity, more debt than earnings before interest and tax, more debt than cash flow, but they have so high of interest expenses. So again, this ratio is a measurement of the ability of a company to pay its interest expense. So Best Buy doesn't have problem doing that at the current financial standing. Okay, let's move on to Macy. Sorry if this live stream is long, but hey, it's my first time. It is what it is. All right, so quick ratio is pretty good for Macy. They have more asset than liability. Quick ratio though, there are need for cash quick because currently they don't have that. Debt to equity, more debt than equity. Three times the debt than earnings before interest and tax. 14 times or close to 15 times its cash flow when it comes to debt. Current interest coverage is pretty good because it's above 3. But what I'm worrying now is the quick cash ratio. Okay. So, let's see. This one is above 1. That's good. More, and this is coal, by the way. So, more asset than liability. Quick cash ratio is kind of weird why it won't show up here, but we'll look into it a little further. More debt than equity, more debt than earning, 7 times, 18 times. Remember, Gamestop is 17, so Gamestop wins. And this is very concerning. See, anything below 1 it just means that there's a signs of trouble here. And I think it's probably having to do with this quick ratio being negative or something like that. It's probably what it was. But this is cool. And if you watch Moran's Rants, he talks about how private equity is in this company right here. And what kind of amazing about that is that if you look at cash balance, dividends right here. See, they still pay out dividends to shareholder, even though they need money right now. All right, well, we'll go down there soon. Nordstrom. Now, Nordstrom, the same kind of deal. 1-to-1 asset to liability. Quick ratio, very low, lower than the current ratio. Debt to equity, 6 times the debt than equity. That's, I don't know if that's good or not. No, that's bad. We want it to be lower than 1, remember. All of these, we want it to be lower than 1 because that's indicative of a good company. Now, debt to cash flow is pretty good, lower than GameStop. So that is good for them, for Nordstrom. But look at the interest coverage. Remember, we want it to be 3 or more. So it's just indicative of a sign of trouble right here. Right, and I bet you anything it has something to do with the quick ratio. they need cash immediately. Now, when a company needs cash, usually they would, number one, either they go to the bank and sell the bank the senior note bonds or whatever, high corporate bonds, right? You've heard of those. Again, don't quote me on this. I'm just speculating, okay, based on what I know, which is very little. Okay, so please don't kill me. But what I'm trying to say is that when they need money, usually either they go to the bank for a quick, $100 million loan or whatever. And so they would, sell bond, just like government bonds, right? When the government needs money, they sell bond to the public, and then they promise a return on investment, right? Whether it's 5%, 3%, or whatever. And usually, the bank wants higher yield than the treasury bond when they, take on any company, retailer, and otherwise, or any company at all. They want a quick return and a higher return on investment. And so company would go to them, or they go straight to shareholder dilution, right? So again, like if you have, just like AMC, we've seen this happen where Adam Aaron choose private equity over retail many a time, right? And it's demonstrating to me that AMC, even though it has this high volume exemption or whatever, because retail has been buying, right? Nobody is selling, but you have a CEO that does not want you to win. And this is why AMC is terrible for shareholder, because again, the CEO doesn't want it to run. Based on his action, though, he would tell you otherwise. But I'm interested in your action. I'm not interested in your words here. But anyway, back to to what I was saying. So, in all of these retailer that the viewer has been mentioning on that comment, they it seems as though that they need immediate cash. So this is Best Buy, quick ratio right here, quick ratio. So let's Google quick ratio. What it entails. What is a good quick ratio for stock? 1-to-1. An ideal quick ratio is 1-to-1. Okay, meaning above 1 is fine, right? Above 1 is good. So suggest that the company has enough asset to pay its short-term obligation. The current asset used in a quick ratio are the one that can liquidate, okay, within a day or two. A company with a quick ratio value below 1 might fall short, of paying its short-term debt fully. So, case in point, you have quick ratio below 1, quick ratio not to be disclosed, quick ratio below 1, severely fumacy right here. This is target, not to mention, because it's probably very low or negative. And then this is Best Buy. So, but guess what? Quick ratio for GameStop is 1. More than 1-to-1. So, again, in all of those retail, they need money, except GameStop. That's why GameStop is such a good position in the future. Again, this is indicative of what future may hold. So, alright, you guys. Oh, okay. One more thing. Okay. So this is the metric that is also most important, in my opinion, right? So we have the financial position of the company. To me, that's indicative of the future. And this is also indicative of the future or the well-being of the company in the long run. Now, we know that Ryan Cohen bought in, right? And especially any other executive out there. So this particular percentage might be higher than it is today. So again, I don't know how accurate this particular website is. It's called stockanalysis.com. So please take that with a grain of salt. But I'm sure it's probably close enough, to the true value here. So as you can see right here, insider ownership, 12%. So let's compare that to other retailer. Okay. Best Buy is pretty good. 11, that's pretty good in my book. I think, and 10% is pretty good. But here's the thing. And to me, this is the theme too, okay? Look at the institution ownership, 80%, right? And this is the reason why all of these analysts are telling you all of these price target. Keep in mind, the low is what the stock is being traded at right now. You see that? So the theme to me that is kind of like evident is that anytime you see high ownership of institution, they want you to either hold or buy. Hold or buy, not selling. Even though, as I was demonstrated already, that these retailers need cash right away because they don't have good quick ratio to do business with, right? They don't have current asset, current liability, cash on hand to liquidate within 1 day or two to service its debt, right? So they want you to buy in so that they could dilute you. They could, sell their position to you at a higher valuation. While Gamestop, institution ownership do not own this, retail own this. That's why they want you to sell it. Why? Because it's undervalued. They want you to sell at $14. Well, let's look at the price real quick, huh? Let's look at the price. Oh, people are watching this. Well, five people, sure. I'm sorry. Oh yeah, price. Yes. Let's do a 15 minutes candle. It's 9 o'clock, you guys. 9:30. I'm gonna get off in 30 minutes. Again, appreciate you viewing if you're still viewing. If not, I still appreciate you if you watch this later on. Right here. Alright, so we're going up. Not too bad. Alright, so let's go back to what I was doing here. But anyway, so I'm showing you this, right? So we did Best Buy already, which is pretty good, 11%. Let's look at Target. Ooh, see that? Boom. So anytime you see inside ownership less than 1%, you might want to run for the door because here's the thing. This leadership gets to run amok. What do I mean by that? It means that they don't care about the stock price right now because, again, they don't own anything, right? Unlike GameStop. Number two, they could just enormously gut this company from within by giving them highly overpaid bonuses. And this is what Ryan Cohen was talking about, how corporate America is plagued with highly overpaid executive, which is why he's not taking any salary right now to set precedent to all of these institutions out there, or all of these CEOs to say, hey, you are here for the shareholder. You are working for the shareholder, not for yourself. Yes, salary should be compensated handsomely, but not overpaying. You have GM executive giving herself like freaking $20 million bonus? What the heck, right? And so it's very frustrating, right? And who's going to lose out here? It's going to be retailer. So you and I, who bought into stock thinking that, oh, it's a good company, it's not going anywhere. Think about Bear Stearns. Think about any other company that went bust. Bed Bath and Beyond, right? AMC, the same dynamic, And it's very frustrating because all of these executives have been cashing out like crazy and they don't care about the stock price, So what I mean by that is that they might see something looming. And this is Target, by the way. Let's look at Macy. Macy, the same thing, under one. More institutional ownership, and look at the forecast. Hold. They want you to hold. Low is 10. See, kind of close to the low, and average, they want you to believe that it's close to $17. I don't know if that's true. It's up to you to analyze it yourself. If you see these metric and still believe in the company, go ahead. But guess what? Who doesn't believe in the company? The inside, the CEO, the executive. Okay. The same way with Kohl's right now. Now it's above 2. That's a little bit better. But again, Kohl's, we know from Marantz, he said that it's fully private equity. I mean, kind of. Everybody in Bed Bath & Beyond went to there, right? Remember that. So I'll let him do all that because he's doing it better than me. And then let's look at the forecast. Of course, they want you to hold. $6. Average should be at 26. And again, look at the institution ownership right here. Where is it? Sorry, I lost the. What? Where is it? Oh, right here. Oh, look at this. Over 100% institutionally owned? That's insanity. Yeah, how can you own more than 100%? Now, this is common, right? Because again, they're going to try to pump it. It's like, oh, this is going to be, if you're long on this one. But again, you have to look into the insider. Who are they? What are they doing? Are they the type of Ryan Cohen caliber? Or are they the type of Adam Aaron caliber? So even though, imagine if you have this in GameStop right now, it would be berserk. It would be crazy. I bet you anything. They would pump it up like crazy too. Because institution, they want to cash out on that as well. So, yeah. Okay. Nordstrom. Now, Nordstrom, I saw it earlier, which surprised me. This is good. Meaning that, they have much more insider ownership. Look at the institution. So, they want you to hold, right? And if you look at the price target, low is 11 and 17 for this one right here. This is Nordstrom, by the way. So it's pretty promising. It's in terms of insider ownership, they have higher insider ownership. That's good. But remember though, quick ratio for Nordstrom it's troubling right here, to say the least. So they might not have the day-to-day cash to do the day-to-day operation, right? And so what I mean by that is that when you take an account insider ownership higher, to me, GameStop is better because the quick ratio is better. Okay. And if you buy into Nordstrom right now, just know that they're gonna either dilute or sell bond to the bank in order to get quick cash to operate the company day to day. And I bet you anything, they are going to do everything they can to dilute the shareholder right now. Now, the float is pretty low, so I am sure that they will go to shareholder first before the bank. But let me go to the balance sheet. Again, this is Nordstrom, you guys. Nordstrom. So let's do a trailing 12 here, because that's a better look. They have increased their cash position right now, in 12 months by 80%. That's good. And here's the current asset versus current liability. You see that? So that's closer to 1. But if you look at shareholder equity right here. Okay. So that, if you do that math right here. Boom, boom, boom. Nope. Too much. Boom, boom, boom. Divided by, now this is in a million, okay? Divided by the market cap. Okay, what do you see there? Market cap is billion. So that's 2,000 something, okay? So that divided by 2,000. Because again, this is in billion, so you have to do it this way. So the shareholder equity is higher than GameStop. Well, I have to do GameStop because they just bring the price down. So currently it's at 28%. So that's good, right? Meaning that for every dollar that you put in, 28% of that is shareholder equity. And since the outstanding float is lower, it's like half of what GameStop is now. It might be cheaper than GameStop. But again, the quick ratio is what scares me, right? For Nordstrom. Now, all in all, I would say Nordstrom is the only one that is kind of like in a good standing than any other retailer when it comes to the quick ratio, insider ownership for this company versus GameStop. And, you see that Ryan Cohen is interested in, Nordstrom as well, right? Well, so the media is trying to tell you, saying that he has some stake in that too. But again, there's no filing here. It might be in some other equity or private equity that he has tied up with somebody else. Evolution Capital. I don't know. Something like that. But from my perspective, there is that if he takes any stake in Nordstrom, that's good too. Perhaps, I don't know. He wanted to kind of copy the business model of Nordstrom to GameStop. Who knows, right? The guy is young enough to make any suggestion or any mistake in the world that he can make. All right, you guys. I think I've been live too long. I need to go stretch my feet. And I might be back later on this evening because I haven't done... I wanted to do the comparison between Tesla, and I might just do a short video on it though. So we'll see. But currently, GameStop is up. So that's good. Man. But anyway, so it's going up. So I'll get off right now. It's been a long time. I don't know how long it's been. Probably, hold on, let me see. Ooh, an hour. That's good. That's a good live stream, I think. First live stream. So I thank you so much, and if you have comment on below, again, this is my first one. I didn't do any reading of the chat, and for the viewer out there, thank you so much for watching, and also to the commenter that allow me to make this long live stream too. I appreciate you very, very much. And thank you so much for being very respectful in this one as well, because you know how it is with people online. They could be very ruly sometimes, and they think that they could just disrespect people just because you know, they can, because it's anonymous, right? You wouldn't say things like that in front of people's faces. So again, I appreciate you. All right, I will end it here. Hopefully I could do that. All right, stop.